get in Rahul Arora, CEO of Ashika Institutional Equities, who joins in on the show. Rahul, great having you. Thanks for taking the time out. I'm sure you didn't foresee the reasons, Rahul, but you are not particularly constructive on markets the last time that we spoke. That view is turning out to be true, and we've had a reasonable corrective move, if you will. But there are clouds on the horizon. Are you turning constructive at the margin, or do you believe there is reason to be cautious?
Morning, Neeraj. Thank you for having me on the show. So at the risk of sounding a little boring, Neeraj, I think that view by and large remains intact. I still think that for the rest of the year, you're going to be in a range of about 24 to 27,000. That view hasn't changed. I personally think that as the year goes on, it could get even more tricky. The US has midterm elections in November. Obviously, Trump 1.0 and 2.0 are very different because right now he has the Senate and the House. He didn't have the House in his first term, so he appeared relatively more rational. But I think, Neeraj, my own assessment by speaking to the people in the US and trying to get some, intel from on the ground, this could probably be a year of very high geopolitical tensions because he may want to avoid the midterm elections altogether. So I don't think we've seen the end of geopolitics. It's going to be a year that you'll have to tread with caution. That being said, Neeraj, I think if you strike back home closer, my own assessment is that in FY28, not the fiscal year that is starting currently in a few weeks from now, my own initial estimates are that the earnings in that year could probably grow by 16 to 18%, which basically means that I think the markets will have a phenomenal 2027, not so much 2026, but there is a chance that towards the last 4 or 5 months of this calendar year, as the sell side moves towards forecasting FY28, you could be in for a turnaround rally, which could potentially take the Nifty to as high as maybe even 35,000. But this is not a call for this year. This is probably more an 18-month out call and purely driven by earnings revival. This is status quo if nothing incrementally goes wrong. If something was to incrementally go wrong, then I'd still say that from whatever low point you hit this year, given what I'm expecting in terms of earnings, you should be able to see a 40% rally in an 18-month period from wherever the market bottoms out. But at this point, I would not be too tempted to believe the worst is over for the market in today's rise. I would not want to catch a falling knife, probably just wait it out because as I'm sure, Neeraj, you've discussed ad nauseum on your channel since this conflict has started, the single biggest risk to India now remains what if crude goes to 100, 110? Then you could potentially start talking about very different numbers. So fingers crossed, let's hope it doesn't get worse. And if you do see an earnings revival, as I'm expecting as the year goes on, then it could probably be a good time to start accumulating stocks 3-4 months from now.
Rahul, well put, and so you've actually been very consistent, and I must appreciate that fact over the course of the last 12 months in particular, right? So if you're not saying exactly the same thing, what you're saying right now is rhyming. But having said that, if you're saying that there is such great potential over the 18-month time frame, then you should be getting your list of stocks ready as we speak right now and keep that check on an ongoing basis. What does your shortlist look like right now, Rahul?
The straight answer to that would be BFSI. I think if you looked at the last set of sectoral deployment numbers that came out for the scheduled commercial banks, if you look at the non-food credit growth, that's actually inched up into the 13% kind of numbers, and deposit growth is inched up to about 11.5%. These are numbers you have not seen for many years in the Indian banking sector. And if this number was to inch up another couple of percentage points where you have credit growth coming in at about 15%, then I am tempted to say that the valuations that you saw in the last super cycle of banks, where you saw the likes of ICICI, HDFC, Kotak trade anywhere between 3.5 to 4 times, I don't see any reason why those valuations cannot come back because these are FII favorite stocks. India is a market devoid of FII money today. If and when the FII money does return, it's first going to find its way into the banking stock. So I think a clear overweight for me is banks. I think we're done with interest rate cuts. At best, maybe another 25, but that too subject to what I was telling Neeraj earlier, that oil doesn't spike. So I think net interest margin pressures are well and truly behind us. Asset quality is very much in check. I think most banks, if you look at their tier 1 and tier 2, are very well capitalized. And the cost to income ratios for most large banks are expected to decrease by 200 to 300 basis points over the next couple of years. put all of this into a pot, stir it really well, and you probably get a situation where bank earnings could compound by 14, 15, 16% over the next 2 years, which makes banking an absolute blind bet in any market correction for me. The second would be maybe not so much because of valuations, but just because of the conflict that's happening globally. And again, something that you guys were discussing a few moments before I came on the show, which is defense. Obviously, the defense budget in India, which was the single highest allocation, I think the finance minister increased by 15%. The order books are so strong for the Indian defense companies that my own understanding is if they don't win a single order from here on and just execute the order backlog, these companies could be able to grow 20% plus for the next 3 years. Consumer discretionary looks all right. Obviously, aviation's been a bit hit right now, but I don't see any reason why that won't rebound once it stabilizes. Alcobev stocks, hotel stocks, so that's another pocket that looks interesting. And two other pockets I'd probably leave you with from a sectoral allocation perspective. If you have auto stocks, no reason to sell. I'd use every dip to buy. And I think this could be a year where pharma could also come back in a fairly decent way. So my entire allocation would probably be rested around these 5 sectors with a clear single overweight or highest allocation, maybe even 200-300 basis points higher than the index weightage on the banking sector.
Rahul, good morning. I see that IT has not figured in your list of buys, is in your list of sells, or is it let's wait and see what happens?
If you permit me a line in Hindi, Tamanna, I think IT could be the hukum ka ekka for this year. I don't know if this is a structural bet I'm going to take, but let me just, sort of put this in an anecdote form. I mean, IT companies in India have so much cash on their books and they still get bought for the wrong reasons. People buy them for free cash flow yield, dividend yield, rupee depreciation. I mean, if you want to trade into IT stocks for those reasons, you might as well trade the currency or any other form. But my sense is that because they are so cash rich, you're going to see an era over the next 2-3 years, or maybe it could start as early as this year, where cash balances of IT companies start decreasing, where they start buying growth into artificial intelligence, robotics, so on and so forth. It's going to be very difficult for the bellwether IT companies to reskill employees. I think, once you cross 35, 40, and you've sort of processed your life on C++ and the likes, it's very difficult to reskill, but you can always buy that growth. So I think you are going to get into a situation where cash levels for IT companies will come down, return on equity will go up, and instead of buying IT companies for the wrong reasons, we may now potentially be buying them for growth. So if you look at TCS, Infosys, HCL Tech, Wipro, most of these companies are projected to grow anywhere between 7 to 10% top line over the next 2 years. With a little bit of margin expansion, their bottom lines would probably grow at 10, 12%. But if they buy growth, and these numbers, like I was talking about credit growth, and that goes into the 13s, you've had such a reset in IT valuations right now that after banks, if you look at, and this is subject to buying, going in and making those inorganic moves, which is why I did not mention it in my first answer because it's an unknown. But if they go out and buy these capabilities, you'd be very surprised. I would not be surprised if IT companies return you 30, 40% over the next 12 months. And this includes mid-cap companies like Persistent, Coforge, KPIT, and the likes who are doing exceptional amount of work, in obviously smaller ticket sizes, but with auto, AI, and other related projects. Coforge has even gone and made a very large acquisition, and that could be a template that a lot of others follow as well.
Okay, so IT is there on the radar, could be the hukum ka ekka, as you say. Any view on FMCG? Seems one of the safest spaces in terms of a defensive play right now, whether it's wars, whether it's AI, whether it's tariffs. Do you think that's a safe bet that you would want to look at favorably?
So again, to use a metaphor, Tamanna, I think sometimes the safest places are where the light is the dimmest and it's the darkest. I think you've got to go really deep into the bunker to find a safe space. Volume growths are not very encouraging, Tamanna, in consumer staple companies. I think even if you looked at the bellwether Hindustan Lever, struggling to do 2, 3, 4% kind of volume growth. Food companies are relatively doing better. I think if you look at Britannia, Nestle, Tata Consumer. So if I was to buy consumer staples, I'd probably stick with the food companies, not so much the non-food staples right now. Of course, you do have a quarter where you have a high single-digit growth shown by a Godrej or a Marico, but these are not very sustainable as we've seen if you take a 2, 3, 4 year CAGR. In a couple of months from now, maybe sooner, we'll start looking to the heavens to see what kind of monsoon predictions we have. And then we'll go back to seeing what kind of rural demand is there. But I think if you want to play consumer, Tamanna, a bad way may not be to play through two-wheelers. I think that is also consumer. If you stretch it out, I think TVS, Bajaj, Hero, in their last monthly numbers all grew various sub-verticals of theirs between 25 to 40%. Valuations, you can argue them one way or another, but at least you're getting growth. So not too gung-ho for paying 45, 50 times valuation for companies that are growing volume sub 5%. But like I said, if I must make an allocation to consumer staples right now, it would be more towards the food companies, Nestle, Tata Consumer, and Britannia. Britannia would be the top of the pick there.
Okay, Rahul, thank you for this conversation this morning. Yes, there are opportunities there, but maybe in another 2 or 3 months, BFSI is top bet as per Rahul Arora.